Welcome to the Pocatello Business Podcast, the only Pocatello podcast focused on providing profits for Pocatello people. If you love our town and love small business, you are in the right place. We interview local legends, learn business, and have way too much fun doing it. You're listening to the Pocatello Business Podcast with your friend, host, all-around great guy, and owner of New Clean Commercial Cleaning, Spencer Ward.
All right, guys, welcome back again for another episode of the Pocatello Business Podcast. Again, you probably noticed this guy's charming face, Daniel Packard from Cooper Norman Accounting and Consulting. But before we get into that, let me take a quick little sponsor break here. Pocatello Business Podcast is sponsored by Pack and Go. And if you enjoy walking up those slippery slopes into the moving trucks, this is not the company for you. But if you like someone that can drop a pot off in your house, you can conveniently load it at your leisure at a ground level, lock it up, and they come and load it and drive it off and store it for you or move it for you to your new home, this is the company for you. Give them a call. Give Darren a call at 208-339-2229, and they will definitely take care of you. They will offer your first month for free if you sign up to store with them, and they'll definitely take care of you. So give them a call again, 208-339-2229. Now, Daniel, back to you, man. Mm-hmm. Thanks for coming back. I'm glad I didn't scare you off last time we were on.
But, it was a blast. I'm glad I'm back.
There you go. So we've had some questions from other guests on the show, and I figured it would be a great one to have you back on to answer some of these questions. But I think a lot of people have questions about just general profit and loss statements, balance sheets, and just, common business questions of, growing pains with cash flow and, when to buy equipment and if there are certain percentages on your P&L that you should stick to. So let's kind of dive in a little bit. What order should we go in today, Dan?
Well, why don't we go ahead and start just by talking about financial statements, talking about what they do when users of the financial statements look at them, what they're trying to opine from them. You'll notice oftentimes when self-employed individuals are even trying to get lending from a bank, question number one is, I want to see your balance sheet and I want to see your income statement. So might be good for us just to talk about what does a financial statement tell us, and how can it inform good business decisions in the future. So with that, Spencer, I'd be happy just to kind of talk through some of my thoughts, unless you wanted to ask me specific questions. Okay.
Please, and then if there's something comes up, I'll ask a further question on it.
That sounds good. An income statement and a balance sheet are kind of the two primary scorecards that a business owner is going to use to determine his or her business health. Balance sheet is kind of a statement, a moment in time saying, how healthy is my business? Do my assets outweigh my liabilities? Am I underwater? Do I have enough receivables to help offset upcoming payables that I'm going to have? How much debt do I have compared to the number of assets that I have, or the value of assets that I have? The balance sheet is a moment in time saying, how healthy are you? How able is the business to make maybe a decision, an investment decision perhaps? That's what a balance sheet does. And in the realm of financial statements, I'd probably put that you got your beginner level kind of financial statements, which we're going to call our P&L and our income statement, your intermediate, which is your balance sheet, and your advanced, which is your cash flow statement. Okay. So balance sheet being kind of that intermediate statement, a little bit harder to interpret what it means and what we can pull from it. So maybe we'll save that for maybe another conversation or another day, and maybe focus a little bit more on the easier rudimentary statement, the profit and loss, or the income statement. Okay. Perfect. The income statement it is not a moment in time statement. It is a period of time statement where we say, okay, from January 1 to, let's say, July 31st. For those months ending July 31st, how much income did I make, and how much in expenditures did I have against that source of income? The goal there obviously always to be profitable. The income statement is valuable for lenders because it helps them determine your ability to cover a debt payment. They use ratios called times interest earned, or a debt coverage ratio, that they just say, okay, does your net income support the payment on a loan that you're looking to procure? For a business owner, obviously the goal is always to say, am I generating profitability? Is all my hard effort worth something? Additionally, is all of my hard effort, am I yielding the same as perhaps other people in my industry? Am I yielding more, or am I yielding less? Is the income statement is going to be the place where all of that is informed. There are plenty of businesses, Spencer, that are seasonal in nature, that if they're running that, let's say that P&L from January 1 through July 31st, that they may be reporting a loss. In fact, no joke, 30 minutes ago, I just got off the phone with a bank, and the bank says, hey, their profit and loss is showing a loss for the first 7 months. What's going on? And the answer is, it's a very seasonal business. They're coming into their busy season. In October, November is when they get busiest, and I'm anticipating they're going to end here. So income statements can sometimes be a little bit hard when you're only consuming a portion of a business's operating cycle. That's why some people will maybe do a trailing 12 months instead of just 7 months in an operating cycle. They may say, okay, I'm going to go from August 1st all the way to July 31st of the following year to try to capture their full operating cycle, looking for profitability. But that's what an income statement is it's a saying, how well did you do during this period of time? Are you profitable? When businesses are being valued.
Quick question.
Yeah, go ahead.
For the people out there, I'm gonna ask. They're gonna say, "Hey, I see my P&L, especially if we're looking on QuickBooks. Depending on what type of company I am, do I run it as accrual or do I run it as cash?"
Yeah,
so
that's a really good
one.
question. So I talked about the beginner, intermediate, and the advanced courses when it comes to your financial statements. Down in this beginner course, cash basis we'll kind of call your beginner course, and accrual probably is going to be closer to your intermediate course. Cash basis accounting is pretty much just saying whatever comes in is income and whatever goes out is an expense, and we record it as such when it happens. Accrual basis is where you're saying, all right, I have sent out invoices for services that I've rendered. I know I'm going to be paid. So that expectation of payment is going to inform me saying I've already earned that income and I'm going to record it as revenue. Same goes for expenditures that I've incurred costs. I haven't paid them yet. Dan sent me his bill for his accounting services. I haven't paid it yet, but because I've incurred that cost, I'm going to record it right now. So accrual is trying to account for timing differences. What it tries to do is kind of widen your gaze to say, this is the expenditures you have coming, and here's the revenue that you have coming in addition to what you have both received and have already paid. So it's designed to kind of be a little bit more wide reaching, whereas cash is going to be a little bit more narrow. I am not opposed to cash basis accounting. I really am not. And there are plenty of industries that can accommodate cash basis accounting very well. An example of that would honestly be dental practices. Most dental practices are operating their books on a cash basis. Money comes in, money goes out, and their practice management software tells them how much they have outstanding in AR. So a lot of business owners, if they have some other software or some other mechanism that tells them what their accounts receivable is, how much money they have coming their way, they often will opt just to do cash basis accounting so long as they know what that number is. Does that make sense?
Yeah, that makes sense. It would also go into place for like a retail setting, like someone owns a clothing store or a restaurant, and people are paying with debit cards and cash right then. There's no invoices going out. Okay.
I like your example there, though. I mean, let's say you're running a clothing store, and every 3 months, let's say you buy a bunch of clothing. Let's say you have a vendor in China that you're buying a lot of clothing from. So every 3 months, you have this huge cash outlay for inventory. Sure. Cash basis is going to make your income statement look really weird. You're going to have months of great profitability and then a loss every time you're buying inventory, right? Accrual basis says, okay, when you're buying that inventory, it's going on your balance sheet. It's not going on your income statement. So it helps smooth out your profitability.
Sure.
So
that makes sense.
Certain industries it's a great fit for. Others probably need to adopt the accrual methodology to better manage their business. So that in mind, what I was going to mention is that the income statement serves that function, telling you how well you're doing operationally. It's also for individuals that are looking to sell their business, oftentimes where people will go to look for some metrics. You'll hear the word EBITDA often, or EBIT. That's earnings before interest, taxes, depreciation, and amortization. Long story short, they're going to look to your income statement to inform what that number is. And so not only does it serve how am I managing my business, it's also used to help people determine the value of your business when and if you're determining you'd like to sell. So it serves a lot of different functions. I have here a dummy income statement. Spencer, is it okay if I share my screen and just kind of walk through some of the nuances here? So what you have here is, again, a very generic income statement. Everyone's income statement is going to be different. There's a lot of times business owners get caught up in saying, okay, tell me all the accounts I need to have, and tell me, build my income statement for me. And really what I'm inclined to tell people, Spencer, is tell me how you want to manage your business, and let's build an income statement that helps you understand your business. I mean, if someone doesn't know what cost of goods sold means, or someone doesn't know what commissions means, but they know what contract labor means, or they know what labor means, let's use a vernacular that the business owner can understand. That's first and foremost. I want business owners to be able to understand their income statement. There's a reason why so many Fortune 500 companies are owned and operated by, I shouldn't say owned, but are operated by those that have accounting backgrounds. It's because this is an important language for people to understand and informs good business decisions. So if your income statement is something you don't understand, if looking at this freaks you out, then delete lines, move things around, retitle things, call them things that don't feel so scary. Okay.
Now, can we start off by just saying, let's put some definitions to the cost of goods sold, also known as COGS, and expenses / overhead. What are the differences between those two, just for people listening?
Yeah. Revenue is making money. So it's what you bring in from your customers, from your clients, from your patients, whoever, that's going right here. And if it's on a cash basis, the moment it hits your bank account, it's reflected right here as revenue. Cost of goods sold is the distinction that you're seeing here is what's the difference between a cost of goods sold versus an expense. A cost of goods sold is a direct cost that you have that moves in complete variability to your revenue. An example here is clothing. I want to keep going back to this clothing vendor that you were talking about, okay? That, a clothing store, they sell t-shirts. A cost of goods sold for them is buying the shirts, assuming that they're buying a manufactured shirt. If they're doing it themselves, then it's going to be the cloth that goes into it, the string that goes into it, and the direct labor that goes into making that shirt as well would be a cost of goods sold. The direct cost that goes into it. I use the word variability. There are two types of expenses. You have a fixed cost and you have a variable cost. A variable cost moves in direct proportion with your revenue, meaning that if revenue goes up, that cost is going to go up in direct proportion. Labor is usually one. Supplies is usually one. Purchases generally is as well.
Workers' comp, because
that would move in correlation with your labor as well. Yes. Others are going to be fixed costs. Those are costs that are going to exist regardless of whether or not you make money. A good example might be like rent, where sure, you could say, well, if I'm not making money, I'm going to leave. I'm no longer going to occupy my space. That's fair. But let's just say you've entered into a long-term lease agreement with a landlord. That's going to be a fixed cost, a cost that will persist whether or not you have revenue. So drawing a distinction between what's fixed versus what is variable is going to be helpful in helping you manage your business. Cost of goods sold are generally going to be variable costs. Okay. That arrives you at your first scorecard or your first marker, which is gross profit, which is going to be your total income, your revenue, your sales, whatever you want to call it, less cost of goods sold is your gross profit. And the margin or the percentage that's created in doing this is your gross profit margin. So putting some numbers in here, let's say you did $1 million in sales and you had $400,000 in costs associated with it. Your gross profit is $600,000. The gross profit margin is going to be that amount divided by 100,000. Let's make that a percentage. 60%. That's your gross profit margin. You put 60% of what you make down to gross profit. Okay? Perfect. Beyond that, you have other expenditures that you have. These other expenses go by a lot of names. Some people will call it SG&A, which is selling, general, and administrative costs. Others just call them non-operating costs. Some even call them operating costs. They go by every definition possible, but they're really just other expenditures that you have when it comes to running your business. So advertising.
I call that overhead, but yeah, whatever.
Overhead, that's great. Yeah, so and you can see, Spencer, in your mind, when you say overhead, you're kind of saying these are costs that I have, these are my fixed costs that I have to prevail beyond, pretty much, right? So I like that word overhead. But, there's a variety of expenditures here. And there will be instances, like I've said before, Spencer, where maybe some of these expenditures find their way up into cost of goods sold based on what industry you are and how you want to run your business. I'm just going to dummy some numbers in here for conversation purposes. Let's say we had 40,000 in some contract labor, 10,000 in your legal and professional, repairs and maintenance. Let's say it was a bad year, lots of repairs, traveling around a lot. Let's go to our rent that you're paying annually as well. So,
and one thing, before you get on that, you're on wages now. So before we go on to that, the difference between wages in your overhead column or expenses compared to the labor in your cost of goods sold. Will you go ahead on clear that up real quick?
You'll notice I use the word direct labor. So that's really the costs that you have that are involved in directly manufacturing the good or service that you're providing. Okay. Now, this is subjective to some extent. You can always make the argument, on this spectrum of indirectly involved versus directly involved in revenue, everyone's going to land in the middle. No one's 100% direct labor and no one's 100% indirect labor, right? There's a spectrum. But using, let's say, a dental office for an example, you'll see oftentimes people will put hygienists or maybe their assistants up in this column right here because they're involved directly in the generation of, let's say, dental revenue. Whereas down here, you'll see the administrative assistants, you'll see the front office clerks, you'll see the billing clerks down here, their labor down here, more indirect, right?
They don't ever touch the teeth, they're just in the back,
Right, so every business is gonna have some line that they draw and saying, okay, this is direct versus indirect, but it's a good question.
Good.
That arrives us at an operating profit, let's say right here, of 195,000. This is also known as your profit margin. So, of the total gross revenue that you generate, how much of it makes it all the way to the bottom line? In this specific example that we ran, 19.5% is making its way to the bottom line, okay? Now, the biggest question I endeavor to answer probably in my business, Spencer, is business owners saying, what should my profit margin be, or how much should I be making? How am I doing compared to other peers? Now, CPAs have confidentiality, requirements placed on them. We don't say, well, so-and-so down the road's doing this good and you're doing this good. So, step it up or you're doing great or keep it up. That's never going to be the conversation.
Sure.
But there is a critical mass of information that CPAs do have, whether that be from a client base that they work with, that they can speak in general terms, or whether that be a warehouse of information that they can access online. One that I use actively, and maybe a value proposition I can provide to you, Spencer, and to your listeners today, is something called First Research. Online, there's a company called First Research. It provides industry stats on just about every industry you can imagine. There's 20 pages of narrative saying, hey, here's on a national level what we see happening. Here's what we see, what we think, what growth we expect from this industry on an ongoing basis. Here's some of the risks that we see, maybe even from a regulatory standpoint, what we're concerned about. And in there as well, sometimes for a lot of these industries, is a common sized income statement that says, here's what gross profit margin looks like industry-wide. And here's what, as a percentage of revenue, what labor should be or what advertising should be. So it's an awesome, extremely powerful report that I think in the hands of a business owner that's astute or just is really curious, I think would provide a lot of value. So for anyone listening today, Spencer, if they want a First Research report for their industry, have them reach out to me or to you, and I'll generate them one immediately and send it their way so they can look through it.
You heard it, guys. Mention the Pocatello Business Podcast, and you got that.
Okay, perfect. Mention it, and we'll send it your way. 19.5% is what I've generated here. Every industry is going to be different, but as a business owner, Spencer, I think this is a good indicator, just a good kind of introspective moment. Like, let's say, Spencer, let's pretend for a moment that this is your business, right?
Okay.
I'd have to say to you, Spencer, you're working your tail off. You're taking on risk. You are employing several individuals and dealing with the drama of being an employer. Is it worth 19.5% every single year? Those are questions that in your honest moments you have to answer. So yes, you're going to have industry norms. That's fair. But the more important metric is saying, am I okay with this return? Is this something that I feel comfortable investing in every single year? And is this something that someone down the road will want to buy?
Exactly. I think that's a big key issue there. Is I think a lot of people run their businesses to save themselves from taxes on a personal side, and they don't ever think of, do I ever want to sell it later? Do I own my job or do I own a business?
Right. Absolutely. And so kind of keeping all those metrics in mind, the income statement is powerful from both a business evaluation standpoint. I love comparative income statements, Spencer, where you're saying, okay, this is what happened last year. Let's compare it to this year. And when we're budgeting, this is our goal. I mean, income statements are very powerful when you stack them up year over year over year, identifying the fluctuations, your growth trend, comparing it to, let's say, a first research report, saying, okay, well, they say the industry norm is 5% and I'm at 3.5%. What's the reasons why? Is it because I'm located in Idaho? Are there regional pressures that are informing a slower growth trend? Or am I not adapting adequately where my competitors are? So it informs really, I think, good questions. Your best competitor, when it's all said and done, is always going to be yourself. It might be helpful to know what other industry leaders are doing, but at the end of the day, there's only one person that you can very accurately compare yourself to, and that's going to be yourself. So look what you did last year, beat it, do it better this next year. Cut costs where you can, gain efficiencies in your revenue, take what was a 19.5% profit margin and make it 22 next year.
I like it. And then, I've got a few more questions and then we go on to the balance sheet. I think we'll just turn this into a 2-episode part, this episode here.
Congratulations on spending a couple minutes getting just a little bit smarter, having some fun, and supporting the Pocatello business community. If you are feeling the love, make sure to subscribe, rate, and review on iTunes, Stitcher, or wherever you are.